Welcome back. You're watching Stockwatch with me, Simon Brown. Joining me to take your stock-related questions tonight, Wayne McCurry from F&B Wealth and Investments, Jared Houston from All Weather Capital. Please be sure to send your questions. Email stockwatch@bdtv.co.za, SMS 41392, or on X using hashtag Stockwatch. Gents, thanks for the time today. Let's start, Jared, with you. Let's start with that Afrimat trading update. HEP's down 75 to 85%. I was expecting a horror update from them, Lafarge, iron ore, etc. Maybe a little bit worse. If anything, does this sell-off create opportunity? What's your take on Afrimat and the update from this morning?
I think I would agree with that. I think the sell-off does create a bit of an opportunity. I think some of the issues were well flagged that you mentioned. I mean, taking on the Lafarge business and the initial losses from the contribution of that business. And then some of the issues with regards to iron ore, whether it be price realization or volume through the trains, was also always going to be an issue. So, I mean, that explains the reason for it being down so much in terms of earnings. But I think the outlook from here is certainly better. They have guided towards getting to a run rate to break even at Lafarge in a few months' time, and then certainly the outlook from there will improve. And then similarly, I mean, prices have improved on the iron ore side, plus volumes are starting to tick up as well. So I think the outlook from here is slightly better, and this is still a high-quality, well-run business, and the pullback does create a bit of an opportunity in our view.
When you're taking it, because the other point, of course, is that they've still got some of their old-school construction businesses left. The president wants to make our country into a construction site. Afrimat must fit into it, surely.
Yeah, look, I agree. I think Jared's covered the whole lot there. I haven't got too much more to add. I think it does create a buying opportunity. You know, if the cycle turns in South Africa and we get better growth rate worldwide, which will mean better growth rate in South Africa and lower interest rates, you know, this is all gearing up to support companies, you know, in this sort of field. Yeah, I think it is actually a buying opportunity.
The other announcement this morning, Mondi to acquire a Western European packaging business. Wayne, I mean, Mondi, obviously they were Anglo at one point, actually, now that I remember about it.
Yes.
They had some challenges with Russia. This looks like a decent deal and a good business. Your take on Mondi?
Yeah, well, look, I mean, Mondi is in actually a very nice spot in the packaging industry. You know, they're in essentially the packaging that's used for online distribution, and that's only going to grow. You know, in the old days, you took 100 bottles of whatever to a supermarket in one box. You know, pretty soon you'll be shipping 50 of those in 50 individual boxes online. So there's tremendous scope for this almost specialist packaging. Now, the one that they've bought is more the corrugated side, as far as I understand. But still, you still need boxes. So, and the price seems quite reasonable, to be honest. I mean, there doesn't seem to be an excess that they're paying for it. It's not a fortune of money. I mean, they're funding it internally, et cetera, and they expect it to be earnings enhancing in the first year. So it actually looks quite good.
Jared, your take on Mondi and the acquisition, as Wayne says, been funded internally, not taking on debt, doesn't look onerous. Mondi attractive in your books?
I think largely agree with Wayne's sentiments. I mean, I think the price looks reasonable, and then, I mean, they have guided to realizing synergies, which makes the deal accretive to them. They are trying to increase their exposure across Western Europe and to essentially buy some growth in a market. I mean, certainly parts of the market are more challenged than the online part of it that Wayne mentioned. So trying to kind of increase the growth inorganically within the business. I mean, acquiring these businesses always presents its own challenges, but I think, I mean, again, this is a business with a good playbook of this type of integration and certainly well managed, well run.
Yeah, I take your point as well. There's always some level of risk with acquiring a business, but this one, as I said, expected earnings accretive from year one. Jared, let's stay with you. Question was coming through. Why is Highprop falling? If my memory is correct, it is ex-dividend today. The second part of the question was, should we buy? I mean, Highprop, of course, they've exited the African assets. They've now got sort of the top mall, some of the top malls across the country. Jared, Highprop, interesting in the REIT space, which has been beaten over the last 5, 6, 7 years?
Highprop's probably not a buy for me at current price levels. So, I mean, I agree with you. The REIT sector has face significant challenges and certainly well off the highs of where it traded 5 years ago. But we've had a significant bounce. If we look at the last quarter of last year and then most of this year, I mean, most of these stocks have bounced significantly. Highprop is well included in that list. I mean, clearly the environment has got better for them, and certainly in terms of interest rates and what that means for their funding costs. So that being a natural tailwind to earnings, plus obviously an underpin in terms of the valuation as well that lower discount rates provide, is positive. For me, I think the sector is now starting to price in better growth and lower bond yields, some of which will take a while to filter through. So it's all about the valuation and what you're getting on a risk-reward basis related to the growth that it's going to deliver. And for me, Highprop still has large shopping centres with. It is a challenge to pass on increases in rentals to some of these tenants. It needs to grow earnings to justify the multiple that it's trading on at the moment.
Wayne, your take on Highprop, which is it's got some office, but it's not. It's retail more than anything else.
Yes. Look, the easy money's been made on these shares. I mean, they were so dirt cheap a while back, and the positives are turning, as we all know, for South Africa. It's not as though it's going to be a great place, but it'll certainly be a better place. And that's all good for the property companies. But as Jared said, it's not going to reflect in earnings for a long time. Good 2 years, I think, before you get the earnings coming through. Because most of these companies, obviously, they will benefit, and clearly their clients and their clients' customers will benefit from lower interest rates. But most of their debt exposure is hedged, so they don't benefit immediately when interest rates start to fall. I mean, the discount rate also, as Jared said, that falling does definitively help, but that's the NAV per share, and we all know they trade at they trade at big discounts to NAV, even though they were far bigger than what they are now. So, look, I think if you want a fairly passive income, it's okay, but the easy money's been made.
I think the index is up 50% since, as you said, Jared, that last quarter of last year. It has been a spectacular run. Wayne, a question coming through around Shoprite. It's been selling off. Does this present opportunity or worry? I mean, Shoprite is the food retailer in our market. Would Shoprite be in a shopping list as it comes down a bit?
Yes, definitely. I think I would stick to that. I mean, the share's not cheap, but it's not cheap for very good reasons. So I would, any weakness, in fact, most of the retailers and most of the banks, any weakness, sustained weakness should be seen as a buying opportunity, because we should hopefully have 2 or 3 better years going forward.
Jared, Shoprite?
I mean, I agree with the broader sentiment towards retail, but it's really kind of is the price fair? I mean, in terms of Shoprite and what you're paying for it, I think that's probably the debate. I mean, business is executing extremely well in terms of its growth plans, its rollout of stores, its entry into kind of adjacent verticals in terms of the retail mix, and it continues to do that extremely well and to gain market share. It's just a case of, now you're paying 20 times earnings for that, so you have to see the growth come through. And the relative gap between Shoprite and its peers has opened up significantly. Granted, the peers have had challenges, but they're going to start to improve off what is a low base. And then I think it's just a debate of what type of retail exposure that you want and what price you're prepared to pay for it. But broader sentiment, lower interest rates, two-part withdrawals and the like, create a better environment for retail broadly. So all of the names should benefit from that.
You mentioned the peers, Spar, Pick n Pay. Would either of those be in your shopping list? Obviously, Pick n Pay's got the Boxer, so in a couple of months we can talk around Boxer as well. Would either they be on your list?
Yes, I think both of those are on our list, both for slightly different reasons. So, I think the Boxer IPO in the case of Pick n Pay the IPO roadshow process has been over the last few weeks, and I think it's certainly been enlightening to understand the quality of that operation buried inside the broader Pick n Pay group, which has probably been underappreciated. So that coming to the market and listing, I think, will attract a very reasonable valuation. And then you've got to assess what are you paying for Boxer inside Pick n Pay, and what is the assumed valuation on the rest. And you effectively are paying a negative price if you assume a reasonable multiple at what Boxer will pay for. So I think that creates a significant opportunity for value unlock. They still need to sort out the corporate store performance if the valuation is going to turn around. But I think certainly risk reward on Pick n Pay looks good. Similarly, Spar's got to the point where it's operating at particularly low margins. They've had obvious challenges in their in their distribution part of their business. I mean, if they are able to improve some of the own goals and turn around the margins of the franchisees, I think you've got a lot of upside off what is a low base in that business as well. So I think both of those positively geared to the better environment, an element of self-help in terms of the turnaround in them.
You mentioned a value unlock. We've certainly seen it with Transaction Capital and the spin-out of We Buy Cars. A question coming through on the We Buy Cars. I've held it since the listing. It's up almost 50%. Should I be taking profit? Is We Buy Cars, Jared, still offering opportunity at these higher prices after the unbundling from Transaction Capital?
I think it's always difficult. I mean, you have this temptation to kind of prune your roses and to water your weeds. Now, certainly, I mean, We Buy Cars looks like it does have a structural growth opportunity ahead of it as it consolidates that independent market that's still very fragmented in the used car space. So, I mean, if they are able to capture that continued growth, it looks like it's a multi-year story of growth. The business, whilst it's turning over its working capital as quickly as it does, it generates very good returns on capital. So whilst that story is intact, I'd be holding on to We Buy Cars for a bit longer.
Wayne, your take is actually higher than I thought. It's just under 32. It had been sub 20 at one point. Wayne, We Buy Cars, and it's the same consumer story to many degrees.
Yeah, I think there's two things to discuss here. One is this, taking profits, and you regret selling any share that continues to go up
every time,
but that's not always guaranteed. And make no mistake, no one jumped out of a building because they took profits too soon. So, if you've made a 50% return, I mean, it's entirely up to the investor. It's not a bad idea to just take a little bit off the table and put it in the bank. But on We Buy Cars, I agree completely with Jared. I think it's still cheap. I think there's a lot of upside left in the share. And, I mean, nowadays, you don't sell your car to little independents and that. You go to Weedy or you go to We Buy Cars. That's it. They are cleaning up that market. The old Jewel Street auto dealer in the south of Joburg there is going to disappear soon. These guys are literally cleaning up the market. It's a bit like storage in the storage industry.
Yeah, I take your point, and it's fundamentally changed the experience of the used car market. I mean, it never used to be fun. I haven't used We Buy Cars, but by all accounts, everyone who has says it works, it does what it says in the sticker. You don't have to go to some dodgy second-hand car park. Gents, I don't know if Purple Group is a stock either of you follow. It's had a fairly spectacular week, up some 20%. But there was also a question on my Twitters, basically saying, and Jared, let's start with you. If we're seeing an improving stock market, surely asset managers / stockbrokers, and that could be Coronation Signia, it could be PSG Financial, it could be Purple, should have a couple of better years. Is there one in that space which is attractive? Alexander Forbes there as well, perhaps.
I agree with what you said. Certainly, if you look at market volumes in the last few months, it's improved and seemingly stabilized at a much higher level. North of 20 billion value traded a day is quite a consistent occurrence now. So, across the market, the broader stockbrokers and Purple Group being within that would benefit. In terms of the broader financial space, I think one we like in that broader space at the moment is 91. So, the asset manager that is geared to both the markets, but in particular geared to emerging markets. And we've seen certainly the SA market do well. And then of late, we've seen a bit of a rally in China, and the broader emerging market theme starting to come a bit back in favor. We had a period where the US was the only game in town, and certainly gathering assets for an emerging markets asset manager has been a challenge. 91 included within that mix and struggled in terms of its net flows. So if we see sentiment improve, we see markets tick up, and we see net flow improve in the business, we think that's another one that can do well for a multi-year story.
Wayne, the asset managers, stockbrokers on the JSE, certainly that bit of positive we're seeing, as Jared says, we're seeing in-pick volumes come through. Anyone that stands out for you in the space?
These are all bull market shares. They do wonderfully in the rising market. Volumes go up. Everyone's happy. Then the market doesn't go up anymore, and then no one likes them. I agree with Jared. I'd rather go for an asset manager. I'd rather go for Coronation or 91.
Let's go to a question coming through around Karooooo. The Nasdaq listing was supposed to do all sorts. It hasn't really, but the business certainly seems to be doing fairly well. Cash seems to be improving. Wayne, is Karooooo, with all the extra O's on the end, worth a look in your portfolio?
Yeah, I think there's 7 O's on the end there. I remember 7 or 9. I remember counting them once. But I actually like the underlying business. You know, whenever they report, it looks good.
Yeah.
You know, they've got, they spread all over the place in the world. They earn non-rand income, which is great, except when the rand strengthens, but that doesn't happen forever. But the share price just seems very volatile for whatever reason. You know, there's no news that comes up and it's down 7% and up 7%. And that always gives me a little cause. Why is this share price so volatile? But I like the underlying business, and I don't think they've actually disappointed.
Yeah. Yeah.
For a long time.
Yeah, it is a volatile stock. It's been heading higher, but it is volatility. Jared, Karooooo?
Karooooo's not one I'm particularly close to, but I would just say, I mean, the broader kind of mid-cap space has a number of attractive opportunities at the moment. I mean, like Wayne flagged, what you do get in a number of these names is the shares trade on relatively low volume, and sometimes there's quite a low free float in them. So it doesn't take a lot of orders to move the share quite significantly. So we do have in and around results events, you see quite a lot of volatility. Yeah. So you just have to make sure you're comfortable in terms of your entry price and just understand the risk that you take in there.
Yeah, absolutely. And it is that volatility. ARC Investments, I'm not sure, Jared, let's stay with you a moment. Obviously, that's Time Bank, which will be IPOing in a year or so, maybe longer. It's Rain as well. ARC Investments, worth a look at. Certainly trading discount to intrinsic NAV. They changed the process of their fees, which seemed to make the market happier. Your take on ARC Investments?
And I agree. I mean, I think I've got a relatively positive view on it. I mean, it's still trading at quite a significant discount to NAV, and I think the underlying composition of the asset certainly presents some interesting investments. I mean, Time, you mentioned, seems to be accelerating its customer growth. I mean, it has launched in the Philippines, and then seemingly Vietnam is next on the list. So growing both locally in SA as well as offshore. Rain, I know there's a lot of debate about the valuation of Rain relative to where some of the peers are trading. But I think what you need to do when you assess the NAV of any holding company is make your own assessment on what you think the valuations are worth. Maybe mark them down a little bit in the case of Rain, and then assess a fair value of the discount for the drag in terms of the costs, as well as some of the fees. But I think the portfolio of assets looks exciting in terms of some of the growth levers. They are still at a discount, and then taking action to address some of those issues. So after a long struggle, it looks like it's finally picking up its head, and the story is starting to improve. Yeah,
and I take your point around Rain. It does look rich, but I like your idea. Work out your own NAV and then come from there. Wayne, ARC Investments, your take on it as all the holding companies are trading at discounts.
Yeah, but Patrice, he's determined to unlock this discount. It's just too big in his view. And I agree, but it's hard to unlock discount here. I mean, take your money anywhere will eventually list, but they're still going to really make profits out of Time. Rain, I mean, this is truly a fantastic business, but they valued it as a fantastic business. And so you got to see, I mean, ask anyone how difficult it is to unlock these big discounts. Look at what Prosus and Naspers have done and done. And Rembrandt and many other, almost all of them have been trying to unlock this discount. You know, so, but yes, I quite like it, but you may have to be patient to actually get that unlock. But the discount does look enormous.
Yeah, no, and I take your point. It's hard to do. And you mentioned Wayne, next day with you, you mentioned Naspers, still a discount to 10 cents. It actually, at one point, it expanded a bit since the sort of Chinese stimulus of 2 weeks ago. Question is, should I jump back into Naspers? Is it a good idea at current levels?
Yeah, I think it still shows some value. I mean, I still think for everything that's happening in China, and there's many problems there, I still think this is a cyclical problem, not a structural problem. It just expanded too much debt in the property sector, essentially, is the concern there. And I think that will eventually work its way through the system. So I don't think this is a structural thing like Japan had in 1988, for very similar reasons, by the way. also a massively overvalued property market with huge debt that just collapsed. But they also had massive debt on their share market, on shares. So I think that the China thing is actually a cyclical problem, and it will recover. And despite the rally that we've seen, these Chinese shares still look cheaper.
Yeah.
I mean, you compare some of them to the American tech, and I know you can't make a direct comparison, but they just look cheap.
Yeah, I mean, you look at the likes of the Alibabas, even Tencent, JD.coms, you compare, yeah, they are massively cheap. Jared, Naspers as an opportunity, as sort of China gets going again, Tencent seems to be on the move a bit.
Yeah, I mean, I agree with Wayne. I mean, I still maintain a positive view with Naspers process. I mean, I think the Tencent asset is incredibly a high quality business in terms of its growth. I mean, this is still trading at a circa 17 times forward earnings, growing, above 20% CAGR easily in the next 3 years. It's returning capital in terms of a buyback of its shares. It's got a large portfolio of investments that it can realize. And it's got a number of growth levers that I think are here to come, and the valuation is still very reasonable. And on top of that, at the Naspers level, you get the discount. Now, I mean, I agree with Wayne. I mean, it's very hard to close these discounts, but at least in the case of Naspers and process, they're taking positive steps and improving kind of the sins of the past in terms of what they've done. So you've seen a major pullback in terms of their capital allocation and discipline on where they spend. I mean, costs have reduced significantly and slowly starting to realize value on some of the assets. I mean, recently sold the Trip.com stake. We've seen one or two other smaller disposals, and I think that continues to happen under the new leadership, which is clearly motivated and incentivized to improve the performance.
Yeah, and making money on food delivery, which I never thought I would see happen. Jared, let's stay with you. Question came through. It's the best way in the JC to get copper exposure. We don't really have a pure play, but of course everyone's got a bit of copper. What would be your preferred pick, or is copper a commodity you want to stay away from?
I think copper clearly has some kind of structural tailwinds in terms of getting exposure to it. I think probably preferred exposure for us in the copper space is Glencore. I think it's one way to get it in terms of how much exposure they've got relative to the other commodities. I mean, clearly Anglo is another way that you can play that, but a larger component of iron ore and PGM exposure in there as well. But I think if you do want to play that theme, Glencore is possibly one way to look at it.
Wayne, your preferred way to get copper exposure?
Yeah, I think I agree. Go for Glencore, Anglos. I mean, obviously Anglos, you're going to end up owning some De Beers and owning some Amplats further down. So maybe Glencore will give you that exposure, but I suppose cleaner, for want of a better word. I wouldn't go for Copper 360 yet. I'm always concerned about relatively new mining startups.
Yeah, junior mining. And there's also Orion, junior mining. I've burnt myself more times than I can count. Sometimes it works, oftentimes it's just a painful experience. Let's go to some stock picks. Jared, you're going with Investec.
Sure. Investec's my pick. I mean, I think if you just track Investec versus the other SA banks post the GNU rally, it has lagged quite significantly. Now still half the business is in South Africa, with the other half in the UK. So I certainly think positive tailwinds for the SA part of the business, being the wealth management and the bank, in terms of better credit loss environment as well as advances. But I think the UK business has also started to turn the corner after a number of years. You've seen improving performance. Again, costs have been taken out of the business, a more focused strategy, and it's driven better returns. It still has a stake in 91. It owns 10% of that business. Yeah. And it also owns 41% of the Rathbones UK business, which has flipped its UK wealth business into. So both those businesses, I think, are very well placed, as well as the core business. And you're still paying around 1 times book for it with improving returns. So for us, risk reward looks very good on Investec right now.
Yeah, no, absolutely. And the banks will look good, but I take your point. It has lagged to a degree. Wayne McCurry, you're going with Intel, which has had a really tough time of it.
Yeah, no, I mean, but obviously now this is maybe not for widows and orphans. I think the market being too harsh. I mean, they have punished this share. And it's sort of, it has gone up a little bit in the last while, but it's still way off its size. And, the use of chips, it's only going to get more and more. I mean, it's going to be an enormous demand for them as everything becomes more sophisticated and can do better things. So, yeah, I think the market's been too harsh because of essentially one update. And maybe there is a glut. It's so strange. A couple of years ago, there were no chips.
Yeah.
but the market very quick to react. So maybe there's an oversupply. And if there's an oversupply now, in 2 or 3 years' time, there'll be an undersupply because no one's going to invest into an oversupplied market. So I think it shows reasonable value at this level.
Yeah, and they've got the Biden chips act is helping them, and also they're talking to Pentagon because Pentagon wants to buy American chips, and there's only one American chip maker at this point, and it is Intel. That's it for Stockwatch tonight. Thanks to our guests, Wayne McCurry, F&B Wealth and Investments, going with Intel, Jared Houston from All Weather Capital, going with Investec. Up next, The Close. Stay tuned.